In today's video, we're going to be talking about the E in the accounting equation. It's all about equity. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence, the T Account Rex. And we're here to put the fun in accounting fundamentals. So today we're talking about one of the four major financial statements, the Statement of Owner's Equity. Now, the Statement of Owner's Equity, the first thing you should know about it is that the name can change based on the types of ownership involved. So, for example, if you have a sole proprietorship, then you might hear it called the Statement of Owner's Equity. If you're talking about a partnership, it might be called the Statement of Partner's Equity. If you're talking about an LLC, it would be called a Statement of Members' Equity. If you're talking about a corporation, you would be calling it either the Statement of Stockholders' Equity or the Statement of Shareholders' Equity. Now, you may also hear it called by another name. You might hear it called Statement of Changes in Owner's Equity. And therein lies the secret to understanding this report. What we're tracking is increases and decreases to the value of an owner's equity in the business. And it doesn't matter whether it's a shareholder or a partner or a sole proprietor, we're looking at changes in equity. What did you start out at and what did you end up at? Now, with the use of accounting software, the Statement of Owner's Equity, whatever you call it, doesn't need a lot of attention for smaller businesses. If the software is set up correctly, everything happens in the background and small business owners wouldn't even really notice that this report exists because the information pulls through directly to the balance sheet without any intervention on our part. For large corporations, more details are needed, and the accounting system needs to be more complex to handle those details. Rather than having one owner, a corporation may have hundreds or thousands or millions of owners. So what we'll do next is we will jump into a spreadsheet and we will look at how the report changes based on the type of ownership a company has. So stick with me and pop on over to the spreadsheet. The first type of business that we want to look at is a sole proprietor. It has one owner. So what the Statement of Owner's Equity is going to do is it's going to start with the beginning balance. So in this case, let's say we have a beginning balance of $10,000. And where does that come from? It comes from our ending equity for the previous period. So last month's ending equity becomes this month's beginning equity. So we've got $10,000 that we're carrying over from last month. Now in this month, let's say that our owner invests $2,000 in the business. And let's say that he or she pulls out $1,000. So they're taking $1,000 out of the business. And then let's say that we have a net income of $1,000. So the changes in the owner's equity are the investment, the owner has put more money into the business, the withdrawal, the owner has taken money out of the business, and the net income has increased the value of the owner's equity. If it was a net loss, it would decrease the value of the owner's equity. So we have a total change in equity of $2,000. $2,000 in, $1,000 out, another $1,000 in from the net income. So that gives us an ending inventory balance of $12,000. Now, when the Statement of Owner's Equity pulls into the balance sheet, what you will see is a summary of what happened with the equity during whatever period of time we're looking at. And what we're measuring is how has equity changed. Now, let's take a look at a partnership. Now, a partnership is going to be a little different because we need to keep track of more than one person. Each partner is going to have their own equity account and each partner will have their own withdrawal or drawing account. And it's the same thing with an LLC, a limited liability company, only instead of calling them partners, we're going to call them members. But the same thing applies here, that we would have an equity account for each member and a withdrawal account for each member. Now, the way that we figure those changes, the formula is the same. We're going to be looking at, did the owners put in investments? Did they take out out money? Did they take withdrawals? And was there net income or loss? And then for partnerships and LLCs, because of their partnership or LLC member agreement, the partners or members can set up their own plan for how they're going to divide out their net income or divide up their net loss. So one partner could get a larger percentage and another partner could get a less percentage. And that's all based on their partnership agreement. So because we're keeping track of multiple partners or members here, we would do something like this to keep track of the capital accounts and the withdrawal accounts for each partner or member in the partnership or LLC. And what we're doing is we are tracking the increases and decreases in the value of equity for each one of those partners or members involved. Now, where things get a little more confusing is when we have a corporation, and particularly a corporation that is selling stock. So we would expect to see a bunch of different equity accounts that go along with our shareholders or stockholders. So we would expect to see common stock, additional paid-in capital common stock. And don't get hung up on these terms yet. At this point, these are just different types of equity accounts, and we will be going more in depth on these different topics in other videos. We've got some preferred stock, we've got additional paid-in capital on preferred stock. We might have other income or loss for things that are not normal part of our operations. Retained earnings, and retained earnings is an account that keeps track of all of our income and expense over whatever length of time the business has been in business. We might have a cash dividends account, a stock dividends account, and a treasury stock account. Now, because we have so many different accounts and each one of those accounts can change during a month or a year, we need to keep track of those changes. And we could do something that looks kind of like this. So here are our different categories, our different accounts. We've got common stock, we've got our additional paid-in capital, preferred stock, additional paid-in capital, preferred stock, other income or loss, retained earnings, our treasury stock, and then a totals column for all of those different pieces. And then on the left-hand column, we're going to spell out what those changes were. So for example, we had net income. Well, net income gets added to our retained earnings, which is an account that keeps track of all of our net income and net losses. So we're going to add that to our retained earnings column. And then let's say we issued some stock and we issued $1,000 worth of stock plus $1,500 of additional paid-in capital. And then let's say we had some cash dividends. Well, dividends come out of our retained earnings account. That is where dividends are dispersed from. So we're going to reduce our retained earnings because we're now paying this out. It's no longer going to be in the business because we are paying it out to our stockholders. And then let's say we also had a stock dividend. Owners are taking a withdrawal, but they're taking it in the form of stock. So we're reducing our retained earnings by that amount. And then we also had a purchase of treasury stock. So treasury stock is our company stock that we've previously sold, and then we purchased it back and we're holding it in our business. This is a contra equity account. So it acts the opposite of the parent account, the equity. And I'll link in the description my video for contra accounts if you need to dig into that a little deeper. And then we also had a sale of treasury stock. So we're no longer holding on to the stock. We've sold it to someone. So that stock is with shareholders again. So we're going to reduce our treasury stock by $8,000, the value of the stock that we just sold. So when we total up those columns, you can see that our equity for the period of time that we're looking at, which is a month, went from $160,000 to $199,500. So what we've done is we've tracked the changes in our shareholders' equity, and then this would get pulled through to our balance sheet. So the important thing to remember with statement of owner's equity is that it's going to be set up differently for different types of businesses, and we're going to track different types of information, but it all comes down to tracking changes in owner's equity. And there you have it, statement of owner's equity. And be sure to check out the other videos for financial statements. We've got one for income statement, balance sheet, and statement of cash flows. Until next time, stay balanced, my friends.